So it's our belief that there is a significant number of asset classes with really attractive return characteristics that for many investors they simply can't access or don't have availability to. We think the experience, the depth of our teams generally provide us with a fantastic opportunity to pull together the diversified asset portfolios in a way that can deliver you a better risk-adjusted returns than from a single asset class or traditional asset class portfolios. So a material benefit there to investors from our approach and our beliefs. Our current portfolio has around about 25% in emerging market debt, around about 17% in equity, and roughly about 13% in asset-backed securities. They're the biggest exposures that we have. Now, in terms of emerging market debt, we implement that in a slightly different way. We have a currency basket that we use, which has got emerging market sensitivities attached to it. So things like the Norwegian krone, the Canadian dollar. That means that in times of challenge for markets, it cushions some of the returns, and that certainly was beneficial earlier in the year. In terms of our equity exposure, as I say, we've got 17% in equity exposure. We take it through a quant-based strategy, seeking to deliver slight outperformance of returns, but for 85% of the risk of equity markets. And asset-backed securities provide you with a return from a relatively unloved asset class that can deliver, sufficient returns that make it very compelling within a multi-asset portfolio. So they're the biggest exposures that we have. But beyond that, we've got exposure to special opportunities, and that's things like litigation finance, we've got aircraft leasing. We really are a genuinely diversified portfolio, as evidenced by its track record. In terms of what we're looking for, we're really looking for asset classes and investments that either exist in our prevailing universe or even in a broader universe. We're quite happy to add new asset classes as and when they come along. In that regard, they clearly have to have attractive risk and return characteristics, and in terms of the individual exposures, they have to have a really good experienced management team as part of that. We therefore also look at pricing, so we look at the valuations. Now, many investments are priced at a premium or to discount, and looking at those actually gives us the indication as to whether we should be increasing exposure or reducing exposure. So we're looking for good ideas that are highly diversified and relative to the rest of our portfolio with a good management team. So when people talk about volatility, they're often talking about equity volatility, and certainly equity volatility this year has been quite considerable compared with 2017 when there was almost no volatility. We can see that the tightening of markets has actually brought quite a lot of volatility. In terms of our portfolio, certainly in the year to end of September, the end of the quarter, it had done extremely well, pretty much what we would have expected. A little bit below cash plus 5, we're not expecting to achieve that in every 12-month period, for example, but it had delivered certainly relatively well. The things that had done less well, unsurprisingly, equities. When equities have been through something of the market falls, as you would expect, they have certainly detracted a little bit. And similarly, some of our insurance-linked exposures have performed less well. They are, in effect, exposure to catastrophe reinsurance contracts. So they haven't done quite as well. On the plus side, we've had infrastructure, which started the 12-month period relatively weakly. Some negative views on infrastructure. We then had the collapse of Carillion in the early part of this year. So infrastructure valuations were relatively low. What we've seen in the period since is those low valuations have actually prompted interest in the market. And one of the exposures, one of the John Lang Infrastructure Fund was recently bought out, or the assets were bought out by a consortium. And that was really a reflection that valuations were depressed, and it's materially resulted in a re-rating of the sector. So in that respect, it's been a contributor to the fund. So volatility has impacted the fund undeniably. Equities have done poorly, but we have our pluses as well. And overall, certainly to the year to September, the fund is up quite materially.